Welcome back to the Dividend Diplomat YouTube channel, everyone. You know us by now, Lanny Burt, the Dividend Diplomat. We are going to talk to you today about UPS and their shocking earnings release and forward guidance and the impact it had on the market. Because Lanny, how many percent did UPS's price fall today
Oh,
after
God.
earnings?
Let me just do a quick double check here because, guys, again, this is April 25th. They dropped a cool hard 10% in one day, down $20 in a quick shot. But this is what dividend investors love to see.
Yeah, that's right. So we're going to talk about UPS. We're going to talk about the earnings, what happened. Then we're going to run them through our stock screener to see, are they a stock to buy after that massive 10% fall?
Let's go, guys. Subscribe to the channel. Give this video a thumbs up below if you haven't already. We know many of you guys are viewing it. We appreciate the love and the support, guys. We are on our way to 20,000 subscribers, so each one counts. So if you're watching, you haven't subscribed yet, please just hit that little red button there. We appreciate it. But yeah, UPS, United Parcel Services, Bert, just released earnings on April 25th. Very wild. It could be a very good opportune time for us dividend investors.
Goodbye. And one quick PSA before we jump in there. Let me know your feedback below. I've been reading all your comments. I've been looking to upgrade my webcam for a while now. I bought one, it's on trial. Let me know what you think of the picture quality. If you think this makes the viewing experience much better for all of you, I'm excited for the feedback. If not, I'll keep trying. I'll return it. I'll keep finding a new one. So, all right.
Yeah,
Oh,
and the audio quality,
mhm.
as well. Let us know in the comments how Bert sounds, how I sound, seeing if this works better.
Yes, absolutely. So let's talk UPS here. What happened? They released earnings. And you know what? The earnings on the let's talk about the earnings because that when you look at the numbers, that's not necessarily a sign of where the bad news came from. The bad news came from when management discussed it. So let's talk about the numbers. They had revenue of $22.93 billion, earnings per share $2.2 per share. When you look at their balance sheet, they still have a very, very strong current ratio, which shows the liquidity on the balance sheet. Can they cover their short-term debt? It's still very strong. It's 1.33x. And the one negative, revenue fell 6% compared to Q1 2022. Again, though, earnings for this quarter were 22.93 billion. So why did the stock price fall down? It was one, how did those earnings stack up against what analysts were expecting? And two, it was management's commentary about what may be coming in 2023. So, Andy, you want to talk a little bit about how the numbers came in against analyst earnings?
Yeah, so first analysts were expecting $2.21 in earnings, and about 23 billion in revenue. Man, they just really missed the
Oh,
ball here. Two dollars
God,
and twenty
not
cents in EPS.
not
So
Gee Briggs.
missed it by a penny. And then revenue, they missed it, again, 22.93 billion versus 23.01 billion. So, you know, eighth hundredth of a billion, still a lot of dollars. But maybe just a few other, again, not significant. That's just a couple of accrual adjustments if management needed it.
Yeah, no kidding. I think they need to talk to their accounting department because they probably should have been able to round that out so that they hit earnings and they didn't just barely miss the expectations. So what drove it though? It was the volume. There was lower volume than was expected. And there's facing some demand issues in Asia. And overall, management's becoming a little softer on what's going to be coming through the rest of 2023. They were very quick to say volume isn't just going to remain under pressure from Q1. It's looking like it's going to be that way throughout the rest of 2023 as the economy worsens, as people's budgets tighten. I think there was one quote in an article I was reading where the CEO was saying people just aren't buying goods that are shippable goods right now. They're spending most of their money on food, on supply, house supplies. They're not buying the things that need UPS's shipping services. So that's why the volume is coming down. And that makes sense. It's tough, especially with how much interest rates have shot up as well.
Yeah, I mean, again, the economy is definitely in we're in a very different territory right now. Again, May 3rd, May 2nd, May 3rd, the FOMC meeting is coming up. Expect another rate hike from Papa Powell, going another 25 basis points. Maybe we'll plateau. Maybe we've got inflation under control. But what's interesting about inflation, which is impacting spend from consumers, is that there's still inflation. Just because it's now only at 5% or 6%, that still means that goods and services are higher by 5 or 6% versus last year, which last year when they were at between 8 to 10% of increases happening, things are just costing more. And I think as of right now, wage increases aren't standing up to it, hence why there are layoffs, hence why pocketbooks are tightening right now, hence why consumers may not be buying goods that are shippable.
Yeah, that's right. So with the softening consumer behavior, with less buying shippable goods, with a tougher economic environment, management lowered their guidance. They're still expecting 97 billion of revenue. They're still expecting strong operating margin. The big thing is the average volumes are going to be down around 3%. That's the big one. Average daily volumes are going to be down 3%. So internationally too, it said it's 4%. We're going to put the chart up here. That's really the story. The softening demand is going to push their revenue guidance, even though it's 97 billion, it's on the low end of management's range. It's leaving exposure to just softer results than they're expecting. Although I would still say $97 billion of revenue is a lot of revenue for a company to make.
Still a lot of revenue, still a lot of cash flow. Again, the balance sheet looks fairly solid. The current assets over current liabilities is still over 1.3x. Again, they've still increased dividends, year after year. They've already increased the dividend earlier this year. When we take a quick look at the dividend stock metrics, which will focus on the price to earnings ratio, dividend payout ratio, and dividend growth rate. And then we'll look at the dividend yield, which obviously has gone up as the price has come down by 10% or $20 a share today. I mean, bro, what are analysts still expecting? What's that PE and payout ratio look like specifically?
All right, after today's price, they were at 176.29. Analysts are still expecting over $11 per share of EPS, forward EPS of 11.41. See a PE ratio of 15.45, so below the market, which is in the low 20s still. Their payout ratio, their dividend's now 6.48. The payout ratio is still perfect. So even with lower earnings, lower revenue, their payout ratio is still forecasted to be 57%. It's beautiful.
So, dividend appears to still be safe, from UPS. And obviously, I'm sure there could be some cost cutting, maybe some potential layoffs coming from UPS. Slower demand, less need for delivery, drivers and other, personnel within UPS. So maybe we should expect that coming up, maybe coming forward, maybe Q3, Q4. Obviously we don't know what's happening behind the scenes there. But if you look at the dividend growth, obviously they've been doing it for over 13 years at an average rate of over double digits, 12 to 13%. And that dividend yield, like we talked about, again, the S&P 500 usually between 1.5, 1.6 to 1.7%. Now UPS is yielding 3.68%.
Beautiful. So overall, let's just run through the metrics. 15.45, 57% payout ratio, 5-year dividend growth rate of nearly 13%. They've increased for 13 years in a yield that has swollen to a yield that has jumped up and swollen to 3.68%. They're just packing. They're just they're having their games.
They are packing. They're packing boxes.
Yeah, that's right. So again, the price is down 10% today. Interestingly, let's take a look at their year-to-date price. They're actually up. They just erased their gains for the year with today. They're up 0.58%. So they're barely up. In the last 2 weeks, they're only down 3.69%.
And today, guys, just full disclaimer, I quickly did buy a share when I could while I was, throughout work. Maybe I was getting the water or something. Bought it at 177.07. So it looks like I missed it by about, almost 80 cents there. But still grabbed one share of UPS. Big fan of the brown truck.
Yeah, agree. I think based on this, it's going to be a great time to nibble. I talked about how it was my second largest position, my taxable account. I'll have no problem adding to my position here. I think this is great price, great metrics, and a great chance to grab UPS well above a 3.5% yield. Not saying you have to go full boat. It's also one of those companies, if you're looking for a good stock, that it's not one of our top 5 foundation stocks, but if you're looking to start building your dividend stock positions, this might be a good time to grab a great company in a wide moat sector like UPS.
So guys, UPS down $20 a share in one day. Is there more to come, more price compression? Let us know in the comments below. Did you buy UPS stock on the big drop, the big Hogan leg drop? Or are you waiting for a further pullback before you do buy shares of UPS stock? Let us know in the comments below.
If you haven't already, subscribe to the channel, give this video a thumbs up, and remember, if you're not with us, you're against us.
Guys, that was Bert and Lanny from the Dividend Diplomats. Over and out.